Hello, I'm Daniel. Welcome here. This will be my first stock review here, so bear with me, okay? So we're gonna walk through Sprouts today, and I'm not a financial advisor. And to be clear, I just bought some Sprout stock yesterday. I've been quite a long-term stockholder of Sprouts. I bought some stocks in 2022 and in 2023. Then I sold them in September 2024 when I deemed them to be a bit overvalued. Then the market went haywire and brought them all the way up to 170. I sold them at 109. And now it's back down again to 80. So a year has passed since I let this stock go, and now another year has gone by from the management and the company, and they have done very, very well for themselves. So I decided to take a new look at the stock, and I deem it to be a really good value at the current prices right now. So I'm gonna walk through what is Sprouts and what do they do and what do I think about Sprouts when I'm not deep diving around the company and its numbers. So here we have them, and very, very simply, they sell healthy food for less. That is their main goal anyways. They're a direct competitor to Whole Foods, which I, as a Swede, don't know much about, and I do not know much about Sprouts either, more than I can get from the internet and all the YouTube videos that I try to consume and all the earnings calls that I have listened to over the years. But they are the direct competitor to Whole Foods, and I think they're a bit cheaper than Whole Foods, like quite a lot. That's my interpretation anyways. But overall, I try to keep my logic for holding positions on stocks and going into stocks very, very simple. And what I really simply can understand and believe in is that people want to eat more healthy. Okay, that is very, very simple. And Sprouts want to take the healthy foods and for you to, as a customer, to be able to buy it for less. Their stores are easier to navigate. They're aiming on smaller stores, a bit smaller than these regular big stores. And they're also trying to lower all the things inside the store, so you as a customer easily can go into a store and get a good look of the whole store, instead of walking into regular stores where it kind of feels like you're inside a maze. When you walk into a Sprout store, have a much better view of all the groceries and the store overall. And they're building their own products for better margins, and that is a value proposition for the customers as well, since it's better prices and they themselves make more money on the product since there's less middlemen. This is just very, very simply the things I think about when I think about why Sprouts will be successful in the long term. And their unit economics, like Jack Sinclair, the current sitting CEO, he's been the CEO there now for 6 years. It's a huge success story here. And what Jack did when he started, he was looking at what their best stores did. And I think the example that he brings up a lot is that he looked at the San Diego store and he saw that they had way more success in this store compared to the other stores, if you would see on how much return you would get on the capital you put in. So he has been focused on smaller footprints, and in that way they are getting much better returns on the invested capital on the stores. And with that and a bunch of other things, they have been managed to have a net margin of 5-6% regularly in this retail environment that they're operating in. It's very common to have a net margin of 2-4%. So they are really, really good at having a high net margin. And a big part of their success is their focus on building these smaller stores, and they get a really good return on it. So what happened with the recent turndown? Like, I followed Sprouts ever since I dropped off the stock at 108 there in September last year, and I hold it on my watch list for the last 4 or 5 years. So I followed them along, and it was now when, like, the last earnings call, they dropped 25%. And from the years that I hold the stock, it's not uncommon for this stock to have really sharp drawdowns around the earnings call. But now it has dropped down a lot. It's come down from 170 down to all the way to 80. And my interpretation of why the market has been beating down the stock so much is two things. One thing being Mr. Market overcompensates on the both end of the spectrum. So when the stock was at 170, they had a PE ratio of over 40. 40. This is not Nvidia, this is not Palantir, this is a high growth retail stock, okay? But it's not high growth IT stock. So to have a PE of 40, 45 on these kinds of businesses is way too high. It's an overcompensation of that. So the market has punished them a lot since they went up and got overvalued. So the market swings in big ways. And the other thing being is when you listen into the earnings call of Sprouts, they talk a lot about comps. It's a lot of focus on the comps. And comps, the meaning of comps, it's the comparable sales to the other stores that they have been having live for the last years. Okay, so this last earnings call, they did not show any good numbers from the comparable sales of their existing stores from the other years. And the reason for this, the management says, is they're coming off really high growth numbers from post-COVID boom years, okay? So let's say you open a store 2020, 2021, and then you look at the comparable sales numbers 2022, 2023, 2024. On those numbers will be really, really good. When Sprouts open up a new store, they expect a return on investment on that capital they put into that store of 30 to 35% after year 5 and onward. That is a huge number. And that is the number behind Sprouts' growth story, is their efficiency in opening up these smaller units. And now when analytics is looking at the numbers and they see that the comparable growth numbers is flat to 2%, they deem that to be too bad for their outlook. But I believe that it's a fair view to say that those numbers from the 2023-2024 they are boosted numbers due to the fact that they're comparing sales numbers from 2022, 2023 up to 2024. And those comparable numbers sure is way higher than you would get from a 2024 to a 2025 number. So it's a very high number that they have to compare themselves with. I deem that to be a fair take on the flatness, on their earnings growth, on the comparable stores that they have. Like, I deem that to be really an overreaction. And from what it seems like, they're executing on all cylinders. Like, they're doing a really good job. So I don't see this to be a fair assessment of the company's growth outlooks forward. But this is my take on the reason why they have dropped so much. Their financial health, they have practically no debt. They had no debt for 2024, but the trailing 12 months, they have taken on a little bit of debt. But this is almost nothing. And if you see the free cash flow, it's $457 million. And if they would have this debt of $40 million, that is nothing. One general rule of guide I have is that you should be able to pay off your debt with 3 years of cash flow, and they definitely fit the bill here. Shares outstanding, they have lowered their shares outstanding from 150 million to 98 million over 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 years. So the last 10 years, they have lowered their share count of like 40%. That is huge. That is such a big number. It's crazy. They're valued at $8 billion right now, and they have a new authorization package of 1 billion share buybacks. That is really, really good to see. And it's definitely something that they can manage to keep up, since they have a free cash flow of 450 million and no debt. It's a really, really healthy company. So valuation-wise, where do they sit at? And with the valuation, everything comes down to what type of growth rate that you can put on the company, okay? So in my point of view, I believe that a 15% growth rate is reasonable for this company. It may sound a lot, but the thing is they're pretty small. Like, they're not small, but they're valued at 8 billion. They have a footprint in 2021 states, so they are not even in half of the US states yet. They manage to open 10% new stores every year. They have a goal of a total store count of 1,400 in 12 years. I deem 10% a year store openings seems reasonable. I think it sounds reasonable. And the 15% earnings per share growth rate I deem to come from three things. One thing being that they managed to keep the 10% a year increase in store openings. Another thing being at least a 2% increase in the comparable sales on their existing stores. That is a very low number. And then I deem the next 2-3% of the 15% earnings per share growth rate to come from their reduction in outstanding shares, because they will probably have bought back at least 30% of their outstanding shares in 10 years time. So if we believe these 15% to be a potential reality and we extrapolate that in the future, they would have a share price of 630 if they would have a PE of 30, which would be my double growth rate on this company. If I would put a rate of return requirement on that for 15% a year, we come down to a fair value today on $157. I deem that to be reasonable. I really believe that they can maintain a 15% earnings per share growth over the upcoming 10 years. And if I believe that, then I believe a fair value would be 157 on the actual stock price today. And if we would like to have a margin of safety on that value, which we always want to have as much as we possibly can, 50%, we almost have a 50% margin of safety because the stock is at 82 right now, which is almost 50% of where it is today. And if we look at the business overall, we want to see a return on invested capital of consistently over 10%. We definitely have it here. And if you look at the top line revenue, we want to have a business that is growing. And you can see that they're clearly growing at a steady pace every year. And if we look just at the numbers, you can see that we have a very, very good track record. Book value per share growth steadily over 10%. Top line revenue 9, 5, 13%. Earnings per share 18, 12, 50%. I deem them to be a really, really good, strong company. And I am a shareholder now once more after I sold in September last year. And this is my reasoning behind it. I try to keep it really simple, and I think the people want to buy more healthy foods for less money if they can. And they definitely have been successful in their smaller store openings. And I believe that there's more catalysts in here when they're growing bigger. They're probably going to be able to get even better margins if they're a bigger size and a lot of other things. But I definitely think that the 15% growth rate is possible. And if you would believe that, then they are a really, really good price right now. Yeah, so that's my take on Sprouts. Make sure you subscribe for more videos. Peace.